All right, everybody, welcome back to season 2 of the Cashflow Chronicles with Mr. Patel. Mr. Patel, how we doing? Do you have anything to say before we kick off the intro?
We need to get our time zones aligned.
Be right back after this phenomenal message.
Greed is good.
The stock is going to go up, down, sideways, or in fucking circles. It's all a fugazi.
Sell it all.
Greed is good.
Huge upside potential, upwards of $60,000.
All right.
I really hate that damn intro is growing on me.
Dude,
I hate it.
The first time I was doing, I was like, I don't know, it's kind of cheesy. But the more I watched it and edited it, it was like, so I'm glad it's growing on you. But there could be some tweaks. There,
Yes.
maybe we'll get it figured out one of these days. But Mr. Patel, I'm very excited. I have a quick story for everybody to get us kicked off for season 2. I'm laying in bed being a complete loaf. It's about 1 p.m. my time, or so I think, because apparently I can't tell time today. And I get this great series of messages from Mr. Patel saying, "We're back at it tonight. Are you free? Let's go." And I said, nothing could make me happier. And so we made it happen. And I'm excited to be here for season 2. We took some time off, but I'm bright-eyed, bushy-tailed, and ready to go for the next couple months until we need another break, if we do at all. But Mr. Patel, I've seen you've took some time last week. How was your holiday last week?
It was okay. I took my Series 65, which I missed by one question. So it's fine. I'm going to take it in another month or so. I just, there were certain sections I wish I had focused on a little bit more, but it's, it is what it is. I think the sections that I did get, I really nailed. So I just have to focus on the ones that I didn't, and things will move on.
So tell people, for the people that don't know in the audience, what is exactly the Series 65, and why did you choose the 65? Why didn't you choose the 66 or the 63 or the 5 or the 9 or the 7 or the 99 or the 112?
Well, probably because the Series 65 is for RIA, which is a registered investment advisor. So if you ever want to one day, create a hedge fund, you want to, create something, you need a few things behind your belt to, give you that credibility, right? So if you want to start a fund, having something like a Series 65 really helps, lets people know on the other side of the aisle that, hey, this guy actually knows what he's talking about. Also, there are a lot of rules and regulations that come with managing other people's money. So, if you want to do it, you have to make sure that you have everything behind you. So, yeah, one of the things about me is that I don't have a finance background, so I didn't come from the world of, like I don't have an accounting degree. I don't have a CFA, but what I do like is I like numbers. And I think a lot of great investors, they realize that, throughout the investing journey, and they realize, hey, wait a second, I can probably turn this into a tangible business. The one thing I realized while I was studying for the test is that there are so many dogmatic practices around managing risk that that you really get a little bit kind of, how do I say this? Like there are opportunities to outperform everyone because the basic philosophy that everyone keeps getting taught, I don't think it's wrong, but I think it's a little bit misguided. And when things are misguided, it presents an opportunity for those who haven't been, kind of like trained under that same style of thinking, because you can think outside of the box, right? So, if you want to be a little bit contrarian, you could, you develop your own strategies. So I think a lot of times people are like, no, you have to follow this pre-prescribed, method of investing, and that's the only way that you're going to be able to make a crap ton of money. And the thing is, that's not always the case. And you can actually manipulate certain things and realize value where others are not seeing it, and do exceptionally well. So a lot of people are always like, oh, you need to be the next Warren Buffett. Why can't I be the next Chris Patel? Why can't I be more than Buffett? So a lot of people, they want to just live by certain other people's things. And by the way, I'm not saying Buffett is wrong or the greatest investors are wrong. All I'm saying is they have a methodology that works for them. They have an investing style that works for them. So I want to take the best parts of their investing strategy, clobber it together with some of my own thoughts and my own ways of doing things, and seeing if I can one day even outperform them. So we'll see what happens.
That's that resonates really heavily with me, because I feel like we've talked about that a lot over the past 80 episodes, about kind of coming up with what your own methodology is, right? I mean, you have your short-term sort of trading method, but you also have your long-term portfolio, and I kind of combine the two, right? So, for me, what I realized is, like, I started off, my first few stocks were penny stocks. That blew up, right? That didn't do well. Then I moved to dividend stocks. Then I realized how much opportunity cost I was leaving on the table. And I've explained that through a multitude of episodes. And I've found now, which I feel like maybe in 20 years, I'll look back and think I was stupid. But for now, I think the majority of my money should just be in the SPY. And then, the thing and the reason being is I'm not a great multitasker, right? So I can concentrate on a few good stocks that I like and, really dive deep into those opportunities. But I can't do that on 30 stocks. So what I'll do is I'll find the 4 or 5 stocks that I really want to concentrate in, that I need to actually like be on top of, and just put, 10 to 20% of my portfolio in there, and then leave the rest of the 70-80% in the S&P, and just let that kind of do its thing. And my hope is okay, 70-80% of my money is in the market. That'll make market returns. And if I can focus and be hyper focused on particular companies, I might not beat the S&P on any given year, because some of those investments will drag. But over time, if I collect the right stocks at the right appropriate times, maybe I can do a better job about time. But to me, I'm okay being early by a year, 2 years, if that means in the long term it meets above average returns. So that's where I'm at with Rocket Lab. That's where I'm at with Dutch Bros. That's where I'm at with some of these other companies that we've talked about over the past, say, 80 episodes. But I agree with you. There's no one size fits all, because somebody could come in and get an inheritance. I go to lunch very frequently with the gentleman who sometimes chimes in to the channel, and guy was fortunate to inherit some money, and so all his goal is to not lose it and live, right? Like, so he doesn't need to be in a situation where you and I are at, where we got a college degree and we kind of started with a goose egg in our next to our name, so we have now built it into 7 figures. He's been fortunate to kind of been handed something like that, and now he's just making sure he doesn't lose it, and so there's people out there that need to think about it in that perspective, rather than trying to grow at all costs and focus on what's the next big stock, because sometimes the next big stock will lose you 20 to 30% overnight, and maybe that's not the game you want to play. So it resonates with me with respect to what you're kind of saying and in that training. But the thing that I wanted to know, though, is there's a lot of different of those series exams that you can kind of take, right? And I've ventured into that as well. And the thing that I always kind of scratch my head at is will you still be able to like buy with the Series 65? Will you still be able to buy and sell on people's behalf, or is it just give you the opportunity to advise? You're on mute.
No, you can have limited power of attorney where you have the ability to buy and sell on their behalf.
Okay.
So
Okay.
it just depends on how you structure the deal with your client, how much you're charging for performance fees and how much you're charging for asset management fees. So you have to lay down a structure. You also have restrictions on the type of investors that you can take on, because of the huge variety of investors out there, where you've got accredited investors and then you also have non-accredited investors. And accredited investor, there's a couple of things. Either the person has background in some sort of financial industry, or they have a net worth of about $1 million plus, not including their primary residence, or combined income over, I think, 300,000 with their wife. 300,000 with them and their wife consistently for the last 2 years, and likely to outgrow that more. So basically, you have to be a person of means. If you have a person of means, you don't require a lot more of the regulatory scrutiny. You don't face a lot more of the regulatory scrutiny would you do if you were like advising like a retail investor. And the thing is, you can advise retail investors, but there's a very finite amount that you can take on. And then on top of it, like, it just doesn't make sense from a time perspective to take on people who are investing $5,000, $6,000 at a time. The other thing you could do is technically launch a fund, whether it be like a mutual fund or an ETF. ETF, you'd probably have to be like a sub-advisor to it, because the amount of regulatory burden that comes with having your own fund is pretty excessive. Like it's not cheap. Like there's a lot of paperwork that you have to file, and you have to continuously maintain and do all this stuff just to basically make things, run decently well. So I think right now I'm at the stage where, number one, I need to just get the test out of the way. Then number two is figure out, okay, how am I going to structure this? Am I going to turn it into a hedge fund where it's completely just, me with a series of investors who are high net worth individuals who want to take a chance on investing in me and my ability to generate returns? Or is it going to be something like in the future to do an ETF? Now, the thing is, the ETF model, it requires you to, at a minimum, have about 25 million under management before you're going to see even a dollar. Okay. The reason why is because, one, there's startup costs to starting an ETF, but then on top of it, your AUM that you charge, usually it's about 0.7 to 1%. If you, let's say, charge 1%, you're managing 25 million, you're getting about 250,000. The thing is, 250,000 is what is required to just keep the ETF active.
Yeah, it's the run
between
cost.
all the yeah. So it really comes down to how you want to structure it, how you want to go about it, how much money can you bring to the table? Because a lot of times, seasoned investors, they have access. Seasoned advisors, they have access to other people with high net worth and high net worths that can throw millions of dollars at the person. So like you need like a wealthy uncle, where basically like, yeah, I trust you with my money. Here's a few $1,000,000. You need to get a whole bunch of those people together to get to the point where you have 25 million.
Yeah,
so I'd say right now that's a little bit further ahead than I'd like to think about. Right now, my main focus and concentration is just on getting the test out of the way. After that, focusing on my own portfolio to make sure that I have enough capital that I can fund at least, I would say, between 25 to maybe 30% of the total AUM required to launch an ETF. If I go that route, or if I do a hedge fund, how to go the other, it's a combination of things. And then also I'm going to see if I can reach out into my network and see if there's anyone who actually privately manages money that wants to take on a shadow for a little bit and, basically show me the ways of the samurai. And, like I would put in my own work into the situation and see where I can go with that. So, there's so many things that are probably going to come our way in the next, 2-3 years, maybe 5 years. I also have some investments that I'm working on that I have a pretty positive outlay. So that could also boost up my own net worth to the point where I might not need a lot more outside funding. I probably still need outside funding, but just need a lot less outside funding. So what I mean by that is, if let's say I somehow miraculously made it to, let's say, $10 million between me, myself, and probably some family and some friends, that means that I'd have to look for another 15 from investors. Now, the thing is, if it's an ETF, it gives a lot more retail participation. So as we develop Cashflow Chronicles, as I develop my own personal branding on Twitter and YouTube and stuff, I think more people could eventually say, you know what, I've seen this guy for the last 2.5 years. He's got a consistent track record of making money. I don't mind putting a few $1,000s. And you get enough people putting up that kind of money, you end up getting over that 25 million limit. And then in which case now you just have to keep maintaining that fund and growing it. And eventually it'll get to the point where it does become something profitable, so we'll see where things go.
That's kind of where, I know you and I have batted back and forth with what our kind of game plan is. And that's kind of where I've always been. My thought process is to kind of get to that 8-figure mark on a personal level and then really venture down that space. And really, it would be more so to kind of help friends and family, because I think a lot of them, they get so excited about particular ideas, but then they don't mind the basics. Like I tell some of my buddies, I'm like, hey, this is a speculative opportunity, put a little bit of money in, and then they completely forget about just putting it in the SPY, right? It's just like, no, this is like a speculative, 1% part of your, net worth sort of gamble, right? It might not necessarily be there. You need to focus on making sure that you're putting in, 15 to 20% of your income every month into something very stable to make sure that you can make it to retirement, right? You don't want to be in a place where you've just been socking away money into these speculative opportunities. And the hope is they're following somebody that does the due diligence, right? But to be very frank with you, it's so easy to start a YouTube channel and a Twitter and speak eloquently and lead people down the wrong direction. And I see that happen all the time. Just because somebody makes, a little bit of money or is a little bit ahead of them, they'll grasp onto that concept to be like, this is the way. And it's like, no, it's not really the way. Have you actually put in forethought as to how it's appropriate for you, right? This person might be day trading 24/7 and you have a 9-to-5 job and don't have the opportunity to be having that due diligence to be able to look out in the markets and be able to maneuver like they can, because that's literally all they're doing. And I see people try to fall down that trap. They'll pay $5,000 for a course. And it's like, anyway.
Yeah, I think you're better. Most of the people that, someone said to me the other day, like, Chris, why don't you do a course? And I'm like, no, I'm not going to do that. Never am I going to do a course. The reason why I'm never going to do a course is because there's too many things to learn. And the thing is, if you apply it the wrong way, you'll get the wrong answer. And the thing is, like, it's really, really hard to teach someone to follow something that you're doing. So it's almost like me going to, let's say, Peter Luger's and saying, teach me how to make a really good steak, right? And the thing is, like, they could try, but the way that they make it is very difficult. And it's going to take such a long time for them to do it. It's not worth it. So instead, it's almost like, can you give me the basic recipe and work with me to analyze things? And then, and not to mention, when it comes down to it, there are some key things that I feel like you only get to learn in the moment that you can't really learn outside of that. And the thing is, I'm still learning myself. I'm not, trust me, there is at no point does any real investor say that they're done learning and now they can just apply and make things work. Like, Warren Buffett lost money on airlines after he had said, I would never invest in airlines, and he lost money on them. So what does that tell you? That tells you that sometimes even the lessons that you teach yourself and you try to, like, put out into the world, you don't even follow, because there are some times where you think that the opportunity is so great that you need to violate your own rules. So all those things kind of come into play. The key, though, is beating the market consistently. As long as we can do that, I think we can prove to the people that we know what we're talking about. So that's why I asked you today, make sure we have our portfolio ready to go. So this way people can say, okay, look, this is what Chris and Matt, their portfolio looks like, and we'll just keep up with that. So there we go. This is our portfolio so far for the year.
For the year, yeah. So let me just give us a rundown here.
We've got some winners and we've got some not so good winners.
Yeah, so we got some winners, but I think overall,
and one of them, of course, is Snowflake. I know everyone is going to troll me on Snowflake because they're just like, screw that guy and his Snowflake. But
yeah,
my thesis on Snowflake has evolved a little bit, but it hasn't changed. I still think there is some potential long term, but I'm gonna have to, like I said, readjust my my thesis on them depending on how they take this AI situation going forward, and then also how the market is valuing SaaS names, because as you know, SaaS names have kind of fallen a little bit out of favor, and that's not helpful.
Yeah. So let me give some folks some guidance.
Are you still there, Matt?
Can you not hear me? Can you not hear me?
Hello, Matt? Am I just talking to myself at this point?
Can you not hear? Can you not hear me? You can't hear me?
I think you're on mute.
You can't hear me?
There we go. I don't know what's going on with your mic.
But you can or can't hear me?
But while Matt is figuring out his situation with his mic,
you can't hear me?
I can hear both of you. Okay, it's me then. Hold on.
I was wondering why you were chatting over me. So while Chris is getting that hopefully sorted out, I'll explain a little bit. So from top to bottom, we have the value of the opportunities that we have. So we have a cash position, and then this goes from the largest value in the portfolio down to the smallest. So don't pay attention to this 11% number. We'll get to the next slide because we have been selling. Chris, you can hear me now?
Yeah, I can hear you.
Okay.
It was me. Someone called me, so.
Well, no good, no worse. So we have been jumping in and out of opportunities. So actually, Chris told me to get out of Celsius and drop into HIMS, and that's obviously one of the new positions in the portfolio. We're up 44% in a rather short amount of time for that one. But we do have some laggards as well, and I have been adding a little bit into, what did I add in recently? Some NEXT, I think recently. Some ABCL added a few. So that's rather that. And then hopping into the performance against, I guess, the S&P 500. This is year to date. So year to date for the SPY is up about 11% or so. We're at about 27%. And that's basically since January up till, I guess, Friday of last week. And so if you want to compare against the Dow Jones, we're up against Dow. You want to compare against, I guess, total world, excluding the US, we're there. And then going to actually what we've been able to do, I guess, since we've incepted, we've put in about $1,888, and the portfolio has grown to about $2,500. So what does that mean? So we're up about 30% since the end of October, and this is the comparison between the balance if we didn't invest. And so I assume that this might include, which I still need to figure out, if this includes interest or not, because that's obviously an important component, because that would put an additional 4 or 5% on this blue line. But this blue line is basically if we just added capital and didn't invest any of the money. But this darker blue is actually what we've been able to return over the past several months. And this is based off of a monthly. So you can see we started at 0 back in September. This is when we first started putting capital in, a couple $100 in October timeframe, and we've been slowly adding a little bit month by month. So that's where we're at over the course of the past, say, 6-7 months in terms of returns. So 30% is not too bad. Mr. Patel, any thoughts on any of these?
I think some of it we probably got a little lucky in that we incepted at the right time.
Yeah.
I think a lot of people won't admit that, but I'll admit it. Like when it comes down to it, when you get in when the market is really shitty, especially what October was, you really do have a lot of tailwind to go higher, you know? So that's just one thing I want to mention. Now, here's the thing. If you're underperformed in the last 6 months, I'm sorry, like that's something that you should reevaluate and figure out, like, why did I underperform during an exceptionally good run in the market? And then, you know, retrace around that. So it'll be one of those things that just, you know, keep in the brain. I don't like seeing that red snowflake number, but it's not something that I'm gonna, like, you know, everyone's gonna have one of those. That's just how it is.
But each play is running its own race. You know what I mean? Like, so the fact that NEXT is up 31% actually kind of upsets me. You know what I mean?
Because we should have went a little heavier into it, right?
Considering not only that, but background on it. So the way that we kind of positioned ourselves in that one is because we were expecting by 2027, 2028, we'd start receiving some cash flow. So we thought we had a little bit longer of amount of a time. And the fact that it's actually started to run means, because we're buying this based off of any dividends that we have coming through the portfolio. So the fact that we don't have as much dividends means we only have 50 odd bucks in there at the moment. So the hope is like it calms down a little bit after this news. And maybe that's a different topic we can discuss either today or another day. But there are some other ones in here that have done exceptionally well. But that's the thing, is like, when you look at a portfolio, it doesn't necessarily always have to go up and to the right. Like my portfolio will have periods of stagnation where it just kind of flattens out. And the next thing you know, I'm up a couple $100,000, you know, and it doesn't happen all at once, right? It'll happen over the course of a couple months, and then it'll flatten out again. And I make some moves and adjustments in the portfolio. And so it just kind of makes you think a little bit as to, you know, what exactly is whatever position you are looking at. That snowflake position isn't a dog position. It might not have been the best entry, but I guarantee in 10 years, we're going to be ecstatic that we bought it, right? Or we're going to use that fuel that generates over the next year or two. I'm sure it's going to be in the green. And we could take that just like we did for Celsius. Celsius, we timed perfectly. We sold it in the 90s. It was a huge position, and we dumped it right into HIMS and made some capital. I wish we bought more HIMS, but
Can you bring the
is.
thing back up again
Yeah.
real quick? I just want to see what our cash position is, because I think there is a unique opportunity in the cruise lines that is actually worth taking on. I've been talking about this on the Patreon for like a little bit, but I think right now is probably an opportune time. So basically, we have about $750 in cash, and we're going to get a dividend payment from BPYPN and BPYPM sometime at the end of the month, which will be nice. So that money will get added into the cash pile. So we've got 152 Rocket Lab spec names. I don't know, man. What do you know about cruise lines?
I played it during the pandemic a little bit because I thought it was a little bit overvalued. And I know where you're coming from. So let me just take a 5,000 foot view. They took on a lot of debt to be able to kind of keep in business because obviously nobody was riding cruises at the time. And with that, they've been able to continue building new boats. A lot of those boats are coming online, and people are wanting to get the hell back out there. Hell, I've even thought about taking a cruise because I've never done one, and I want to see a bunch of different countries, and it's probably the easiest and cheapest way to do it. So the fact is I've thought about that as well. And they also offer very competitive rates to kind of book ahead. And so here you are now looking at, full dockets, new boats coming online, and the debt is staying, the same amount, right? Now you have all this additional earnings that's coming in, revenue coming in, but the debt and interest payments kind of remain the same. You're obviously done a lot more due diligence, so I'll let you explain it a little bit better, but that's kind of my thought process on where it's at right now.
Yeah. Let me see if I can share this right here. Okay. Can you see my screen? We're going to take a look at, hold on. Okay. Can you see were you able to see my screen? Yes?
Yeah.
Okay. So here's what's going on. Okay. We're going to take a look at the three major cruise lines. Actually, one just came out, Viking Cruises just came out, and they have been absolutely on a tear the last month. They just IPO'd at 24, 25. If you were in the inner circle on the Patreon, you knew ahead of time. So congratulations. But everyone else, Viking is just getting bought up. They have a different business model than some of the other guys do. So one day I'll probably discuss this a little bit more in depth. But the two that we're going to look at are Carnival, and we're going to look at Norwegian. But before we look at Carnival and Norwegian, we're going to look at Royal Caribbean. Royal Caribbean is the reason why we're going to look at Royal Caribbean first is because they have been able to recover back to their pre-pandemic prices. So if you look at Royal Caribbean, December of 2019, they were at about $125. Right now they're trading at $147. So they have essentially recovered their stock price. Now the question is, why did they recover and why didn't Norwegian and Carnival recover? And we'll go into that in a little bit. But if you look at the financials on Royal Caribbean, and we go on a trailing basis, you can see that on a revenue basis, they've actually been able to grow their revenue beyond what they were making in 2019. Okay, so in 2019, the top revenue that they had was about 10.9 billion. Right now, they're doing about 14.7. So they're doing almost about 4.5 billion more than they were doing in 2019, which was pre-pandemic. So that's kind of nuts to begin with. So that's cool to see. And the reason why they were able to do that is during COVID, they actually had a few ships on order that came online. One of them being something called the Icon of the Seas. Thing is like $2 billion, but it is gigantic. And the amount of money that thing is throwing off in terms of cash is just staggering. So if you look at on an operating income basis, Royal Caribbean is making more money operationally in 2024 than they were in 2019. In 2019, they made about $2 billion of operating income. Right now, they're doing about 3.3, and it's accelerating higher, by the way. So this number looks like it's going to get even higher over the next few years. So their operating income is actually more than what they were before. You look at their margins, their gross margins have pretty much, I mean, I always hate seeing things like this because it really like distorts the chart. But if we look at the operating margins on Royal Caribbean, they had about 44%, 45% operating margins pretty consistently for almost a decade, right? So you can see here, this is their operating margins. Now, if we look to their margins, I mean, sorry, not their operating margins, their gross margins. If we look at their gross margins, they've actually exceeded a little bit, but they're topping out at this point, right? So they went from about, let me just go back to this thing. They went from negative whatever to now almost like 45% operating margins, which is what they've historically done. And so I don't think there's a lot of room for them to grow their gross margins even more. On the other hand, their operating margins should be able to get a little bit higher. So if we go back, we can see that their operating margin was about 19 to 20%. Right now, they're actually doing 22% or 23% in operating margin. So they're making more revenue and they're more profitable now. That's the reason why they've been able to recover, right? If you look at their EBITDA, same thing. Their EBITDA is actually more than they were making in 2019. In 2019, their EBITDA was 3.5 billion. Right now, it's about 5 billion. Now, one of the reasons why they haven't gone even beyond their current valuation is because they did issue some shares during COVID. So you can see here, all of this right here is the share issuances. So their share issuances kind of went up. They also took on a good amount of debt, which meant that they were paying about 1.8 billion that's not it. There we go. This right here. So they were paying about 300 to 400 million in debt or interest costs. Now they're paying about 1.4, 1.5. The thing though is that they're making so much more money that now they can probably work on this debt at a faster pace, right? So if you go to their cash flows, you can see here that they're generating about 4.9 billion, 4.5 billion in operating cash, which means it gives them some leeway to pay down debt. Now, yes, their capital expenditures right now are running about 3.8, but this is something that's something that they can control. So in the future, they could reduce down their capex a little bit and use that additional cash flow to pay down debt, in which case now debt servicing becomes cheaper and they end up doing well. So you can see here that that's what they were doing. For the last year, they've been paying down their debt with additional cash flow. So Royal Caribbean has done exceptionally well in managing their capital, managing their dilution, and the market, of course, is recognized that and has rewarded them with a giant increase in their share price. So if you had got in the lows around $32, you'd be up 4x right now on Royal Caribbean. And there's still probably something to be said about Royal Caribbean going a little bit higher. So if we look at their forecasts in terms of stock price, looks like they're going to do about 16 billion, 16.5 this year. They're going to do almost 18 and then 19, and then it kind of like flat lines to about a single digit growth going forward on their top line. Bottom line, of course, they're going to be doing whatever they need to do to improve their debt, in which case then it improves their interest charges, and as it improves their interest charges, it becomes more profitable, in which case this will be their their EPS. And then you just run valuation against it, and you can figure out like where this company is headed.
So two questions, Mr. Patel. Obviously, then the next thought is, what about Carnival, right? And then the second question is do you think that this management team, or overall the management teams in the cruise line business, have recognized maybe not to go as in depth with building, let's just say, so many ships at once, where the fact that they get to a place where their cash flow gets massively impacted. It might be more of like a couple ships at a time rather than being like the multitude of ships. I think a lot of them had like 4 or 5 different ships being built at once.
Well, I mean, the thing is, they were following demand, right? These are actually, believe it or not, if you look at something like Carnival, and you look at their balance sheet prior to COVID, this was a pristine balance sheet. This was literally, they had like about 10 billion. But if you look at the total interest charges that they were paying at the time, there were barely any interest that they had. Let me just put it up. Sorry, where is the damn interest charges? If you look at Carnival's interest expenses, right? They had very low interest expenses. They literally were paying about 200 million per year for interest. Okay. So their shipbuilding program was actually pretty nominal with what was going on with demand. So demand was picking up. So they were doing about 3 additional ships. And the thing is, over time, you got to remember this is a depreciable asset, right? So for every 30 years, the ship has to be scuttled and you have to kind of have another one ready to go. So the thing is, if you want to grow your fleet size, not only are you investing in increasing your increasing your fleet, but you're also investing in replacing the older ships that may have been built 30 years ago. And as the thing is, like with Carnival and Norwegian and Royal Caribbean, some of their ships are 20, 30 years old. So it just goes to show that this is kind of a capital in, capital out business. The good thing is they do generate cash flow on top of that. So if we look at like Carnival's cash flows, or actually their net income prior to COVID, they actually had a pretty good, where was their net income? Sorry. Right here. Prior to COVID, they were actually doing well. They were doing about $3 billion a year in net income. So I wouldn't say that this is
That's really a quarter.
No, that's a TTM. So it's a
no, trailing 12 months.
3 billion. Yeah. So it's 3 billion, a year. The key here is that these businesses will run pretty well, even prior to COVID. The only thing is COVID was one of those one-time kind of like act of God level events that really knocked them back. I think the other problem that kind of came up for these guys is that we could have been at a better place in terms of their valuation had it not been for the follow-up right after that with high interest rates. So imagine right now you have a business model that, number one, is very debt light. It's actually running on operating cash flows, which is awesome, right? And then COVID hit. So now your income is zero, but you had ordered all these ships 4 years ago, which means they're all going to be delivered to you during COVID, when at the same time you're not really bringing in any dollars. So you have to finance those damn things. And then on top of it, once like you're back to normal or somewhat returning back to normal, you're like, okay, great. We can run our ships again. Everything's going to be great. All of a sudden now interest rates shoot up. And so the cost of your debt is absolutely wild. So you don't have the opportunity to kind of refinance that debt down, and it becomes a drag on your earnings. The good thing is, if we right now are taking a step back and saying, okay, look, their operating efficiency has gotten back to what somewhat of a normal level that they were, prior to COVID. All the second part to that is now those interest and that debt, and basically paying down that debt and also refinancing the debt where possible. And this is where you have to do like an analysis on the debt to figure out, okay, where are the opportunities in each company to right size their balance sheet? Because as they right size their balance sheet, their earnings will naturally grow, right? So if you figure out how to not pay 2 billion and only pay 1 billion, that means that additional billion that you were paying last year ends up going back into your net income, which means now you have an additional $1 billion to play with. So these are the kinds of things that you have to do as an investor, and just like go through. And then like there's so many nuances to it, because each one of these cruise lines is operating a very different strategy to managing their future. So if you look at like Carnival's goal is, hey, listen, we have enough ships. We are going to cut our CapEx. So if you look at 25, 26, 27 and beyond, usually their building cycle is about 3 to 4 ships a year. Now they're only doing 1 or 0. Like they only have 1 scheduled for 2025 and 0 scheduled for 2026 to be delivered. They have 1 for 2027 and then maybe 1 for 2028. So you can see that their CapEx has gone pretty pretty down, right? So historically, they were spending a lot more. Now they're kind of controlling that capex. That's a good thing because that means that that additional money that they're not spending on capex is actually going to be used to pay down debt. Now, if they're smart about it and they take out the debt in the right places, that can be very value accretive to them going forward. Norwegian is a little bit different in that they're like, we are just going to grow ourselves. We're going to grow and we're going to maintain some operating efficiency. So we are going to grow out of our problem. Carnival is like, we're going to cut our way out of the problem. Norwegian is like, we will grow. And as we grow, we'll generate more money, in which case we'll use that money to pay down debt. And and each one. Royal Caribbean's like, hey, listen, we didn't issue that many shares and we didn't take on that much debt. And our ships are gigantic and our operating margins are through the roof. So we are going to do just fine. And that's why Royal Caribbean was able to recover the fastest. The question is now with Norwegian and Carnival, how do they recover? How do they get back to the point where they were like Royal Caribbean? The unfortunate reality that I have to just put out there, I don't think that they get back to their same levels for quite some time. Like I'm talking about 5 years out. The reason for that is because both Carnival and Norwegian, they issued a crap ton of shares. They literally diluted their shareholders by almost 50%. So because of that additional dilution, you're not going to see the same level of earnings. But that doesn't mean that they can't get higher than they are today, right? Because right now, if you look at their stock price, compared to prior to COVID, it's down 70-80%, which is kind of crazy, but it makes sense because if you freaking dilute your shareholders that much, you should be cut in half. And then if you took on all this additional debt, that means that now your equity portion should go down lower too. So I think right now they're both fairly valued. I don't think that there's a lot of additional value in them, but, and this is
You're saying that's Royal Caribbean and who else?
No, not Royal Caribbean, Carnival and Norwegian. I think right now the current stock price that they are trading at is actually fair value, okay, for the current numbers that they're putting out, okay?
In terms of net income, cash flow from operations?
Yeah, from everything. Everything low. I don't think that these are value companies, but here is the kicker. I think both of those companies know how to strategically delever into a point where they're going to be generating a ton more value in the next couple of years, right? So the thing is, structurally, when you make some decisions on the credit side, you can bring a lot of shareholder value. And the thing is, it just takes a little bit of manipulating of your debt. And I think that's the part that not a lot of analysts are doing on it. They're just looking at the overall debt number and saying, too much debt, not worth investing in, don't touch it. And I'm a little bit different. I'm like, no, I mean, as long as a company knows how to manage their debt, they'll be fine, Right. So the best way that I could describe it is like, imagine right now you got a great job, you have a mortgage, you lose your job, and you start putting some of your loans on the credit card, right? And then you find another job and you start making good money again. And people are like, someone says, oh, but he's got a shit ton of credit card debt. Fuck him. I would never trust him with the money. Right. But here's the thing. Now the guy's got a job again. He could pay down the credit card. And as he pays down the credit card, he becomes a better creditor going forward and actually making more money again and getting back to the point where he's investable again. Right. So I think a lot of people right now, they're looking at the total debt and just kind of like scuttling a lot of these, both of them. And I think that with the operating efficiencies that both of them can kind of bring to bear, you're looking at about a nice 4 or 5x return in about, I don't know, 5, maybe 10 years, just depending on your total outlook and how they end up performing. And there are risks, of course. There's no investment that doesn't have any risk. But I think for anyone trying to grow their portfolio, both of these companies are well positioned.
Yeah, and I'm just looking at Carnival specific because it's lagged the others by a pretty substantial margin. Yes, it's up 30% over the last year, but it is pretty cyclical and still way down from all-time highs, likely because of the stock count that you mentioned. Just looking at the past 5 years since 2020 timeframe on an annual basis, they've issued about $42 billion worth of debt. they've paid back about $28 billion worth of debt. So that's like a surplus of about $13 billion that they still have added to their balance sheet over the past 5 years. Ops
Wait,
cash,
who are you talking about? Who are you talking
this
about?
is Carnival in particular. So I don't know what their total debt is. I'm just looking at their cash flow
It's about
statement.
28 billion. 28 billion right now.
Total. Yeah. Okay.
Yeah.
So I'm just looking at the statement. Actually, let me just share it so everyone can kind of see. You had it up earlier, but this is what I'm just looking at. So I'm looking at, the ops cash is about $5.5 billion, which is pretty impressive.
You should probably do quarterly. Well, not quarterly. Yeah, I was gonna say you should do. Well, I don't know. Do you have like a TTM? Because I think here's
TTM's this last column here.
Okay. The only thing I want to say about this is when you look at these charting softwares, start trying to use TTM for like to look at it on a linear level. And let me explain why. Seasonality is huge for this business. So there are some businesses where seasonality doesn't matter. They generate money like this, right? Straight and up and to the right. With cruise lines, they have like 2 quarters where they absolutely go crazy with the amount of revenue and the crazy operating income that they can generate. So the thing is, like, when people look at it like on a 1-year basis, what they're doing is looking at last year, but they don't necessarily get an understanding of how it's improving linearly. I don't know if I'm being a little bit obtuse with that, but
no, I don't think so. But I think one of the things that I was just going to highlight specifically is the ops cash being pretty impressive, right? $5.5 billion. I'm not seeing the capex go down, but you probably have the forecast of the capex, right? So I'm looking at what's actually been done versus what the forecast is. And that's the main thing that I've been kind of wondering. So now that you kind of hit that, it's like, all right, well, now if they're able to sustain that $5 billion a year in terms of ops cash and reduce that capex to say $1 to $2 billion a year, it looks like they've already been able to get a pretty good jump on the repayment of the debt, right? I said over the past 5 years, $42 billion has been issued, a lot of which, this isn't over the past 5 years. This is quarterly now, but basically over the past 5 years, $42 billion has been issued, $28 billion has been paid back. So the surplus over the past 5 years is $13 billion. You mentioned $28 billion total debt. You think about it, if they're able to start chipping away at that, at the amount of about $3 billion a year or something like that, they don't have to pay it back, right? They could keep the ball in the air and hopefully refinance at cheaper interest rates. Hopefully in the next couple of months, we actually start seeing some interest rate cuts. And as they do that, they'll be able to reduce their interest rate charges. And with that, this ops cash, instead of it going towards interest payments and capex and everything the like, can go towards more buying down the debt. So what I think you're trying to say is they're probably at the peak of their debt and will probably come down. And it's likely due to the fact that they're going to reduce their capex going forward. And so what you're saying is hopefully they're able to kind of sustain. And if you think about it, if you look at it from a price to cash flow perspective, Carnival in particular is $19 billion. If you're able to generate, say, $5-6 billion, you're looking at a price to cash flow of a 3 to 4x, which is pretty impressive, right?
Now here's what'll blow your mind. Look at Norwegians. Norwegians is even better. The only thing about Norwegian is that their debt is not as strategic. I mean, Carnival has some debt. Like I really had to do a fundamental debt analysis to figure out one of the benefits for Carnival. Carnival has some debt that's very strategic that it can knock out. Norwegian doesn't have the same thing, but I mean, Norwegian is pretty good too. So it's kind of like, which one is good? And I'm like, both of them are good,
Right.
So,
yeah, I was more, let me see. I was doing cash flow. So let's look at cash flow. So I mean, their ops cash is back up to 2.3 on a trailing 12 month. Let's see how much cash flow. CapEx are still spending a good bit, $2 billion. So that's tough. This is on an annual basis, though. So who knows? Maybe, I don't know. I mean, are they expecting to increase cash flow going forward, or is it kind of topped out?
Yeah.
I don't know how many additional boats they have coming on.
They have quite a few boats actually coming on because they're in growth mode, right? they're not in conserve mode. But the key with them is that look at how much they're paying in interest.
Where is it at here? Interest expense. This is still annual. Yeah.
Yeah. Let me share my screen, man. I don't know what. I highly recommend you stop using Yahoo for.
Yeah. I'm with you.
Okay, so this is Norwegian. Okay, this is Norwegian Cruise Lines. Basically their income statement. So we can see here the revenue right now is actually beyond its 2019 level. They're doing about 9 billion. So they're doing almost 50% more just revenue than they were prior to COVID. Now, a lot of the reason why is because one, they were able to get on new ships and then also increase their prices on their tickets and all this other stuff. And now they're on a 12-month trailing basis, they're net income positive, right? And this net income positive is coming from a combination of things. But if you look at their interest expenses, they've been able to lower their interest expenses down significantly. I have to look into the reason why their interest expenses kind of went down so much, but basically they're doing about $770 million in interest expenses per year. Now, what I really was shocked to see is the following. Their EBITDA is about $2 billion, okay, per year right now on a trailing basis. What do you think their market cap is?
For Norwegian?
Yeah. What do you think their market cap is?
I don't know. I know. I just looked at Royal Caribbean. It's like 30. Norwegian? 15?
7 billion is their market cap.
Interesting.
Yeah. So that's why a lot of price targets, everyone's been readjusting their price targets much higher. So I'm looking at this. They look like they're going to have pretty good growth going forward, and their EPS is going to be growing along with it. So by 2026, their EPS is going to be about $2.45. This is what they're guiding for. I think that they get there pretty easily, to be honest with you. You give it a 12 PE on a what is that thing called? 12 PE as a conservative. Let me just see. So it's 2.45 times 12. You're looking at about $30 a share, right? In 2026. And then if you do 20, which has been more historic for them, 2.45 times 20, that's $50 a share. So let's say cut the difference in the middle and just say 15, right? So you're looking at 245 times 15. You got yourself a pretty good return for the next couple of years as they improve their numbers. So yeah.
Interesting. So what are you reserving the trade for the Patreon folks only, or you already kind of
no, let's do it. I already kind of put it out there, so it's not that big of a thing. I mean, there's a way we're going to play this that's a little bit, more, how do I say, lucrative. But I think for our portfolio, we should probably add both of them and use them as long-term holds,
Yeah, it's a good point, because it's not that I've ever not focused on Carnival, right, or any of the cruise lines. I think the point that I was waiting for was this point where they get to a place where they're back up and running again, and they have the income coming in, and they've been able to get to a place where they're able to start paying it off. And so I think this is an opportune time for sure. And it's one of those things where when you're doing due diligence and when you're looking at companies, I don't want to say timing is everything, but in a particular case like this, where a company's going through a turnaround and had such a big black sheep event like this one has, or this industry has, timing does kind of matter, right? And it's not to say that's the case for every company, but I feel like this is just how companies kind of operate. There's a lot of times where companies will be in expansion mode, and then they'll focus on efficiency, and then they'll slowly retract and be able to try to cut off certain parts of the business here and make it a little bit more leaner, and then they go into growth mode again. And so there's these expansion and contraction phases that a lot of companies go through that I think a lot of people can kind of take note. and think about. Oil and gas companies do this extremely regularly as well. But we don't need to dive down that rabbit hole right now.
The one thing that I'm kind of like I tried looking for some positive stock analysis videos on these guys. And the funny thing is I couldn't find any. I think everyone was doing their analysis. They're just looking at these companies like, I don't want to invest in cruise lines. So they've got the bad taste of COVID in their mouth, and they're kind of just like done with it. They're like, I'm not touching these things. They're like the airlines, they're just too much risk involved, blah, blah, blah. So they're just not willing to touch it. Now, the thing is, we have to look at the history of why this happened. So, of course, this giant drop was COVID, right? That's not undeniable. Everyone finds out about COVID. Cruises are shut down. And over time, slowly, they start getting back to normal again, and they're growing. Everything's great. And then Omicron. Remember Omicron? Good old buddy came in and kind of just like dashed the hopes of everyone. And now they started back in their descent again. And then you thought, hey, everything's going to, be okay. Let's start going back up again. And then what happens? War in Ukraine and Russia, and interest rates go up because of inflation. And now they're just like, oh my God, these guys have so much debt. What are we going to do with it? And this is where everyone is missing out on the action, because everyone for the last 5 years have been burned by this industry to the point where they're just like, I can't touch this. I don't want to. I don't want to be in it. Now, here's the thing. I think the recovery is going to be there. It's going to be slower paced, right? It's not going to be like a Royal Caribbean where these guys are just monsters, man. Let me just do a Royal Caribbean comparison. Hold on. RCO. But over time, they will recover also. So Royal Caribbean has just been able to manage their business really well, and they're back to normal again. These two, it's going to be a little bit. But essentially, the business model is actually a pretty good one. They've got pretty much third world labor, so they've got pretty low operating costs. They're actually switching to a newer type of fuel on their ships, which is more stable and cheaper to service. So they're switching away from bunker and trying to use more liquid LNG. And they're also going to be doing, I think, methanol to a certain degree. That should help too with their profit margins. And then there's all these additional value-added services that they can add on, like Carnival is investing a good amount of money in Starlink, where now there's really good internet on these cruise ships, which means there's probably a segment of the population that could work from home. They're like, hey, why don't I go on a 7-night Mediterranean cruise and just work from the cruise ship and go see the Mediterranean? How cool would that be? Right?
I would do that for sure.
So I think it's opening up some categories to newer cruisers. And then you also have this giant retirement community kind of like coming on, and baby boomers love cruising. So I think this is another thing where you have this population that's coming, that's retiring, that have all this additional money and cash, and they have got time, because that's what you need with cruises. You need time and you need money. Baby boomers have both. They're going to love this. They're going to eat it up. And I think all of these cruise line companies are going to do well going forward. So we'll see.
Interesting. What else in the portfolio? I know we only got 2 minutes left. But any other precursors in the portfolio, or is this the current big one? I know you've chatted about a few others, but
I'll be honest, I am a bit worried about tech. Tech seems toppy. No one likes to say it, but it's the truth. Now, the thing is, you have to be very selective when you say tech, okay? Does that mean Google is overvalued? No. Does that mean Microsoft is overvalued? No. I mean, these things are always going to be valued at the upper range of their PE, so I don't think that's the case. But if Salesforce taught us anything, it's that demand for enterprise spend is starting to kind of like slow down, right? And enterprise SaaS may have a few rough quarters ahead of it, in which case now we may get a valuation reset lower. So, if you're a SaaS company that has enterprise, that's basically in the enterprise, you may feel some pressure going forward. So I'd say we should, and this is where I'm a little bit kind of sad that we still have Snowflake. But I mean, this is one of the things about investing, right? You just kind of realize, hey, the market's kind of turning right under your feet. You think everything is good, and then all of a sudden now everything's starting to kind of shift. So you have either one option. You either have, hey, I'm just going to stand my ground, ride the wave out, or I'm going to downshift, move my money out, put into something more lucrative, and then wait for it to come back. Now, the thing is, our position size isn't that big. Like it's barely maybe like 5%. Is it what percentage of our portfolio is like Snowflake right now?
Snowflake? Oh, it's super
Yeah.
small. I just closed it. Let me
Yeah.
see.
So if it's super small, it may not make sense to be in it. Now, here's the thing: at the end of the year, if we're still down, it may not be a bad idea.
7%.
Yeah, it may not be a bad idea to kind of, sell it as a loss, use the loss against, because I know some of the stuff that we have is actually stuff, right? That we've sold. So use it against a gain and call it a day, and then wait 30 days and buy it again if you really believe in it. So
Yeah, it's always a plausible situation. I will say before we end, one of the things that I've managed to navigate beautifully was, remember how everybody and their mom was really against renewables towards the end of last year? And Enphase got caught up in that, and a lot of different companies got caught up in that. Well, the one company that I wrote about a couple companies on Seeking Alpha. One of which I wrote an actual article on, and another one I kind of just mentioned in passing. But one has kind of been, where is it here? Let me pull it up. That's recovered rather nicely since I started covering it in like the October timeframe, is Orsted. So this one hasn't recovered that much, but this is October timeframe, November timeframe, end of last year, when I was like, these things are kind of getting overdone. And so I recognized this at like the $12 to $14 range, and now it's back up to the 20 or so range. And the one I really took a decent position in, and I wish I bought more. I'm up 30% in the portfolio, but I didn't get the exact bottom that I wanted, is NextEra. And that was one. I mean, this is the largest electricity provider in the United States, as well as the largest renewable portfolio in the United States. So it didn't make sense when it just nosedived from the 70s down to like the $50 range. And I think I started accumulating at this downfall here. So I think my average is about $62. But here I am, riding it up to close to $80. And, I think it's got some room to potentially go. I think it'll pull back briefly. But I think that if anybody's looking at this, these guys are going to be generating about $4 per share in earnings, and has a decent dividend, right? So it's not going to be one of those barn burner, face ripping sort of companies that you could do, but could be a company that if you see it come down in time, pick up. I think I might end up trimming this because I think it might be overrun here. But we'll see what happens. But for now, I'll probably hold it for the next week or two. We'll see where it ends up going. But just goes to show you that you don't need small sort of companies, right? You can make money off of companies that are down and out or have had just a sentiment change. Exactly what Chris is talking about with cruise lines, right? Like people are leaving it for dead. Why the hell did this thing get hit? I think it was literally just interest rate issues. People were expecting interest rates to be cut sooner. These are very interest rate intensive businesses. So I think a lot of people just turned on them. And here we are. Company's still printing money, right? And it's still, I think, maximum profit compared to what it's ever seen. And it's like, okay, well, maybe we overdid this massive 50% drop off in the stock price. It should probably go back to being somewhat normal. So, it doesn't necessarily mean that you really have to find the next Palantir or anything like that. If you're just smart and look for great companies, you can replicate that swing trade very regularly. I did something similar in Caterpillar in 2019, right? And if you looked at Caterpillar in 2019, actually, I just have it up, and then we maybe can end on that unless Mr. Patel has something else. But this is one I actually regret selling. I didn't think I would, but here I am saying, yes, I regret. But 2019 time period, it was hanging out like the $110 range down here. And that's when I kind of accumulated it. I sold, I think, in like the 220s, 230s, so like around here. And here we are on a face ripper over the past year, up being about 60 odd percent. So I probably missed out on an additional 60 or so percent on that one. But I can't complain because I doubled my money. You know what I mean? But at the same time, I don't remember what I sold and put Caterpillar into. But regardless, it just goes to show you, old businesses, sometimes if you are just catching them at the right time, that they're out of favor, and they're great businesses that are going to continue to be part of staples of the U.S. economy, then it just makes sense to buy them, right? And I think a lot of the reasons why this one took off was the Inflation Reduction Act, the infrastructure bills that were kind of coming out at the time. And so when it ran to 240 or something like that, I sold. But maybe it would have been prudent to hold on to it for the longer term. But it's going to show you Caterpillar's not going out of business, right? They're switching and they're innovating to be running off of LPG or even natural gas going forward. So they're trying to find a way to keep up with the times, lower emissions, just like everybody else is trying to do at the same time. So you don't always need to go and find the newest dog that's doing tricks. Sometimes you can find great companies at great prices, like Warren Buffett always says, and pick them up at the right time.
You want to know something funny? I brought this carnival thing and I brought this Norwegian thing to some people's attention, right? Like some people I respect. I was like, can you guys take a look at this? And they just said, absolutely, no, I'm good, man. I'm looking at the numbers and I don't see it. And I'm looking at it, I'm just like, how could you not? And I realized, number one, their refusal to look at certain industries, mainly because of that debt. I think that people are looking at that debt and just freaking out. And this is where the opportunity really is, because the thing is, like, debt is one of those things that, like, if you're okay managing it, you're actually doing, you can do well. It's just a really like funny thing to see. Like, I feel like this is one of the more obvious things in the market, yet people are missing out on it. But what do I know? We'll see.
I think it's still too early, right? I think it's in a year's time when they really start getting after it. And if Carnival specifically, that's the one I've kind of done at least a little bit more digging into. If their CapEx really does go much lower, that's the one where I'm like, okay, that makes a lot of sense. They're going to be able to retire a lot of this debt, and do it at a pretty good pace. And then you can start to see how they can kind of navigate. But I think right now, just with what it's at, they're still at peak debt. They're still not necessarily 100% recovered in terms of the revenue. A lot of them have actually gotten back to better than 2019, but I think that they're just initially looking at it and being like, debt to income and blah, 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 blah. That's scary. But it goes back to like what happened with Transocean and a lot of these other companies. If you're able to navigate it, and you're able to navigate it well, there's a lot of opportunity to be had.
Now, here's the thing. This is where you have to like be a little bit like not risk averse, but like be willing to take a little bit of risk. But one of the things that I'm starting to see, and it makes a lot of sense, is already credit markets are unfreezing, not just for these guys, but for everyone. This is a good example of something that just came about literally in April. This is after the debt that we saw. They were able to refinance 7.62% euro denominated debt down to 5.75. Now it's like, oh yeah, they were able to kind of reduce down by 2%. The thing is, 2% is actually a pretty big amount if you annualize it out. And on top of it, they also have another agreement where they amended, where they actually did a prepayment on some of their debt as well. Because now that you have this cash flow, you can prepay some of the debt with that additional cash flow. So right here, they repricing amendment for $1 billion of first priority under the term loan agreement in 2008, which is 1.7. So if you combine these two, it's about 2.75%. What they were able to do is reprice it down from a 3% on top of SOFR to 2.75. The key here is that it's SOFR. What I like about this scenario is that, number one, they paid down, let me see, where is it? How much they did? One of them, They repaid about 500 million, and the other one they prepaid 300 million, and then they also lowered the interest on it. Damn it, where is the right here? Okay, I found it. Okay, so right here, in addition, the company has previously announced repricing of 1.7 blah blah blah. Right here, as part of the repricing transaction, the company has made a partial payment of 500 million under the 2008 secured facility, and then made another prepayment about 300 million. So they reduced down the debt by 800 million on this debt. So number one, you're paying less interest going forward, but then also you're able to negotiate a lower interest rate. And then on top of it, so if you look here, it says right here, interest rate, total debt expected to result in net reduction of interest of 30 million for the remainder of 2024 and 50 million on an annualized basis going forward. So, if you took 50 million, you annualize it, out, not annualize it, sorry. So 50 million times 50, you're looking at about $750 million of market cap that was added for reducing down that debt. So if you keep at it, these small changes, they really do impact the overall balance sheet and the income, and they do it in a very meaningful way. There's some debt that's coming due in the next technically it's not due until 28 and 2030, but that debt was issued with, I think, about a 10.5% interest rate. I think next year they take it out completely. That's like $3 billion that they take out completely. And that means that now they have $300 million of additional net income that's going to fall right to their bottom line. They have so many little opportunistic ways that they can really dig themselves out of this hole. And like I said, over the next couple of years, we'll see it happen. So.
Yeah, and that's the thing. I think a lot of people assume that you have to extinguish the debt. It's like, no, you just need to keep the ball in the air, right? And eventually, inflation plays a part of it as well. I think what happened with Carnival and a lot of these cruise industries, they needed debt at the most inopportune time. And so people were able to charge 10%. And of course, if you don't have any cash coming in, they're going to be like, well, 10%, that's going to be pretty tough. I wouldn't be surprised if they chimed into the 12 or 13% range for those things as well. But if you think about it, it's like, even just, let's just say you had $10 billion worth that's at, let's say 10%. If you were able to refinance that at a 5% or a 5.5%, that's $1 billion. Sorry, that's $500 million a year that you're kind of relieving off of that.
50 million, not 500 million.
No, 10 billion at 5%.
Oh, yeah. Oh, you're right. You're right.
Yeah. If you include everything that they went,
because
they issued Carnival specifically issued 15 billion in 2020.
Yeah. So here's an example of some of the debt that they have that strategically they can really knock down and make a big difference. So right here, they have one note for 2027. It's almost like a 9.9% yield. If you look at outstanding, they had 623 million. Now it's zero. So they were able to knock that out, right? That note they were able to get rid of. A lot of this other debt that's floating rate, so SOFR, that means overnight funding rate. And Euribor is like the European equivalent. When the Fed starts to cut interest rates, this goes down. The SOFR rate right now is about 5.25%, right? Which means, or actually, no, it's actually might be 5.3 or 5.4, whatever. But if the Fed gets back to what it's supposed to get back to, according to the CME, which is 2.5%, you're looking at a huge reduction in SOFR. So the floating rate will go down, which means it'll benefit them again. They also have this one right here, which is that $1 billion I was talking about. It's due in June 30th, but it's yielding a 10.5% coupon, which means that with additional cash, they can knock this out. Now, here's the thing. Why haven't they paid this one off yet? Do you know? Do you know why they wouldn't pay that one off yet? Why they're waiting for this one?
No.
So the thing is, when a lot of the debt was issued, the thing is, and this is where you have to really dig
Like
into
a minimum length or something, or
Yes, yes. So there's something called when you issue debt, there's something called call provisions in there. So let's say right now you come to me and says, Chris, I want to borrow money. And I say to you, sure, how much do you want? And you're like, I want to borrow $1 billion. And I say, well, I want 10%. But the thing is, I don't want you to pay me back right away. Right. Because if you pay me back right away, it kind of means that now I'm basically not really making that much money off of you. So what happens is I could say, well, you know what, Matt, look, this loan is for 10 years, but at the 5-year mark, you could pay me back, and basic we'll call it, we'll, you can just not pay anymore. So the thing is that call provisions for those two maturities is coming up in 2025. So there's about $3 billion that's like that. In my opinion, if they took those out, that's $300 million of interest cost savings on just those two debt maturities, right? They're going to be generating close to $5 billion in additional cash flow to pay down this debt. Their target is to get back to investment grade. They're looking at about 6.8 billion, according to guidance, 6.8 billion in EBITDA. So they'll reduce down the debt to 20 billion, which means that let's say they have an average of like 5%, because of the interest rate cuts and everything else. You're looking about $1 billion a year in interest charges, 2.5 billion in depreciation. So you got 3.5 out of 6.8. You're left with about between 3 and 3.3 billion in net income. You divide that up by the shares outstanding, which is about 1.3 billion in shares outstanding. You got $2.45, maybe $2.50 of earnings. Multiply that by 14, boom, you got yourself a much higher stock price than it is right now. So you're looking at an easy double. So whatever, like I said,
that's the hope.
Yeah.
Very good. All right, my man. Well, I appreciate it. Yeah, I know we wanted to kick back, and we'll see how frequent we can do this. Hopefully the cadence is a little bit better this time around than what we've been able to do in the past. So any final thoughts before we sign off for the day?
No, I think tomorrow we should do more macro. So macro Mondays will be the topic, because there's a lot to be said about the current macro. And I think the economy is starting to slow. The rate cuts are starting to bite, and they're biting hard. So, I think portfolio positioning right now is not a bad idea to just rotate out of growth, be in more value, be in more things that are irreplaceable, things like utilities, Verizon. It's easier to cut expenses on discretionary items than it is to cut on something like that's necessary, like a cell phone plan. So
that's interesting. I guess my thought is I guess if you're thinking there's going to be some sort of recessionary pressures, my thought is as you let go of some of the high interest rates, it's going to be very beneficial for small caps that we've kind of been waiting for throughout 2024. But maybe that's something we can get into a little bit more tomorrow.
I believe it or not, I think rate cuts are going to usher in the recession, which is the bizarre world.
That's generally what happens, right? Is we always wait too long, and then there's some sort of recession, and then we end up cutting, right? I mean, just like what happened with.
Someone asked a very good question: is Verizon viable, even though it's a run since you recommended it? First of all, I didn't recommend shit. Okay, I don't recommend anything. Let me just make that disclosure very clear.
Chris makes his own investments.
I make my own investments. I talk about what I like and why I think it's undervalued and why I think it's going to go better in the future. But you have a strong telecommunication company that that's giving you about 6.5% just dividend yield right now. I think in the future, people are going to be yield starved. So not only like right now, we've had the last couple of years, everyone's gotten used to like a nice like 5.25% from the treasury, and it's like, I just keep my money in money market. I'm gonna, they're getting fat off of that money. Especially these goddamn baby boomers who've got $1 million in the account from selling their home that they bought in the 1980s for a song, right? So now they're gonna need yield. That's one of the things that rich people like doing. Rich people like staying rich. So in order to stay rich, you're going to look for yield, especially income. So you're going to need that. So people are going to be buying like, oh, should I buy some random company or should I buy Verizon? I think a lot of people are going to be buying Verizon. A lot of portfolios that are dividend portfolios are going to be buying Verizon. Right now is a time to be looking for companies that can generate money throughout any sort of economic environment, and also throw off cash that they can get back right into their dividends. So yeah, I'll go with that.
One of these days, I have to talk about my Airbnbs.
How's that working out for you, by the way?
Yeah, we can talk about it. We closed on the other one on May 10th, so that's been a lot of fun. I knew that it was going to be a lot of work. I don't think my sister knew it was going to be as much work. Fortunately, I live in Texas and she lives in Pennsylvania, so I'm not the one doing the work, but I am shelling out money. So, but we actually, believe it or not, the 10-week season is really the important thing. The one's kind of on coast mode at this point. That thing prints money. We bought it. It was an existing Airbnb. We've had return customers. That one works well. So that one, we're pretty much fully rented for that 10-week peak season. This one, we're at about 3 weeks out of 10 because we just literally got it on the market. So hopefully the season really starts at the end of this month. So hopefully we can fill it out. We've only been up and running now, quote unquote, on the site for about a week and a half. So fingers crossed, we're already at 30% for the summer. So fingers crossed by hopefully the end of this month. And luckily all of the first half, well, we still need to see. We could potentially rent the 3rd week of June out. We have to get our rental license back. But right now, the last week of June and the first 2 weeks of July are rented. The rest, we're still in chats with other folks. So hopefully, fingers crossed, we have 10 out of 10 weeks. And we enter the winter time frame with about 4 or 5 months of mortgage payments. That's the goal. So anyway, so things have gone relatively well. But yeah,
luck.
if you're ever in New Jersey on an off-season night and you and boss lady need a place.
Here's a question. What's the interest rate that you got on the Airbnb?
Oh, it was terrible. It was 7.5 or 7.75. Awful. Absolutely awful.
So here's one thing. I don't know. Maybe I'll recommend it to you offline. So we'll talk once we go offline. So
okay, very good.
Yeah.
All right, everybody. We will chat in a little bit, hopefully tomorrow. Take care.